Welcome to The Explainer. Today, we are digging into a U.S. Senate investigation that pulls back the curtain on a financial product you've probably never heard of. But get this, it's at the heart of a massive tax controversy involving billions of dollars and some of the wealthiest people in the country. Okay, so let's just dive right in. To understand what's going on, you first have to understand the core strategy the report says the ultra-wealthy use to legally grow their fortunes and pass them on, often without paying a single dime in taxes. It's a simple but incredibly powerful three-step plan. The Senate report puts this phrase, buy, borrow, die, right at the center of everything. And it's not just a clever name, It's a very precise description of a playbook used to build dynastic wealth, a method that really takes advantage of some key features in the U.S. tax code. So the process is pretty much exactly what it sounds like. First, you buy assets that you expect to grow in value. Then, to fund your lifestyle, you borrow against them, usually at really low interest rates. Now, this is crucial, because you never sell the assets, you never have to pay capital gains tax. Then when you die, your heirs get everything. And here's the real magic trick. Thanks to something called the step-up in basis, the value of those assets resets, effectively wiping out a lifetime of taxable gains. But what if there was a tool that could make this whole strategy even more powerful? Well, that's exactly what the investigation found. The key to perfecting this strategy, it argues, is a financial product most of us have never heard of, private placement life insurance, or PPLI, and it is absolutely designed for a tiny, tiny fraction of the population. Now, I know what you're thinking. It has life insurance in the name, but the Senate report argues its real function is something else entirely. It's basically a tax-advantaged wrapper for really sophisticated, high-return investments. It lets all the gains from things like hedge funds grow completely untouched by taxes. And this slide just lays it out perfectly. You've got two completely different worlds here. On one side, you have traditional life insurance, a tool for financial security for millions of families. But on the other, the report says PPLI is basically a high-octane investment vehicle for the super rich. I mean, to even get in the door, you usually have to be a qualified purchaser, which in plain English means having at least $5 million in investments. So how is a product like this actually sold? Well, the committee got its hands on some confidential marketing materials, and boy, do they reveal exactly what the pitch is to potential clients. And there is no ambiguity here at all. The sales pitch isn't about providing for your family in a crisis. No, it's about investment access. The main feature, as this prudential brochure points out, is the ability to put your money into hedge funds and other fancy investments, all tucked inside this tax-free wrapper. And the benefits are spelled out right there in black and white. Lombard, a major player in this space, points to two key advantages: passing on wealth tax-free, that's the die part of the strategy, and getting cash through tax-favored loans, that's the borrow part. See? It's a perfect fit. To make it even clearer, Lombard even gives an example of use. Just look at the profile, a client with a $50 million net worth. His main goals aren't about security. They're about transferring wealth and, this is the key, minimizing the burden of taxes. And the solution they offer? A PPLI policy, of course. And here is the payoff, straight from Lombard's own chart. They compare a $10 million investment in a regular, taxable account versus one inside a PPLI policy. After 30 years, the taxable account is worth $36 million. The PPLI account, it skyrockets to over $90 million. That $54 million difference isn't from better investments. It's almost entirely from avoiding taxes. So this all begs the question, how widespread is this stuff? For the very first time, the Senate investigation actually put a number on the scale of the PPLI market here in the U.S. And the committee found that the market has a face value of at least $40 billion. That's the amount of wealth that's set to be passed on to heirs completely tax-free. And the report stresses this is a conservative number, since it doesn't even include the huge offshore PPLI market. When you break it down, the numbers show an incredibly exclusive club. We're talking about just 3,000 policies in the whole country. The average policyholder has a net worth well over $100 million. It is a tiny, tiny sliver, just 0.003% of the entire U.S. insurance market. But despite its small size, this industry is absolutely booming. Looking again at the market leader, Lombard, their PPLI assets under administration nearly tripled in just 7 years, jumping from $1.3 billion to over $3.3 billion. This suggests a rapidly growing popularity among the ultra-wealthy. So, if this tool is so powerful and it's growing so fast, what's to stop it from being abused? Well, the report points to a key role that's supposed to act as a guardrail, but it argues that role has a fundamental weakness. The main rule is called the investor control doctrine. In simple terms, for the tax benefits to apply, the policyholder can't have direct control over the specific investment decisions. The insurance company is supposed to be in charge. It ensures the policy functions like actual insurance, not just a personal hedge fund. But here's the problem the investigation found. This rule is nearly impossible for the IRS to enforce. And the main reason? Policyholders aren't required to disclose that they own a PPLI on their tax returns. So the IRS literally has no idea who holds them, unless one just happens to surface during an audit, and audit rates for the wealthy have fallen sharply. The report argues this creates a massive blind spot for regulators. So based on these findings, the report doesn't just identify a problem. It wraps up with a strong call for Congress to step in and create new legislation to address what it calls the PPLI tax loophole. And the committee's proposed reforms are pretty direct. First, tax the earnings annually, just like you would with a regular investment account. Second, create mandatory reporting so the IRS knows these policies exist. They also call for significant penalties and rules that would cover both onshore and offshore markets, preventing people from simply moving their money elsewhere to avoid the tax. And, importantly, the report draws a very clear line in the sand. It says that the goal is not to change the tax rules for the 99.9% of Americans who rely on traditional life insurance for financial security. The target, it argues, is a very specific, abusive investment product used exclusively by the wealthiest individuals. And that leaves us with the fundamental question at the heart of this entire investigation. It really forces us to think about the line between a policy's original intent to provide security for families and how it can be transformed into a powerful tool for accumulating and passing down immense wealth, all while bypassing the tax system.